Withdrawing money from your retirement account is no fun when the markets are behaving badly. The biggest downer? Selling assets at depressed prices. Selling low forces you to burn through more shares to raise the cash that you need. And that means you'll have fewer assets in your accounts to grow when the market does come back. However, another consideration has to do with the creep in your current withdrawal rate. What do we mean? Well, likely at retirement, an acceptable withdrawal rate was determined, and it may have been assumed that over time this would be adjusted higher for inflation. Well, typically this rate is around 4% of the portfolio value at the time of start when withdrawals begin. However, when the markets are flat to down, especially for an extended period of time, this current rate may now be higher than what was initially planned. What's the danger? Well, if this current rate gets higher than what the portfolio can potentially earn over the long run, then one, the portfolio will either slowly continue to decline, or two, force you to take on more risk than what's appropriate to make up for those losses. So then, how can we be proactive when it comes to withdrawal rates and market downturns? Well, number one, look for ways to reduce your spending. Now, this may seem obvious. Start by tracking recent spending, drawing up a budget. Now, I know budgets are never fun, but this will be helpful to know where that spending is going. It will give you a sense as well, areas where you can adjust. This is important because even temporarily reducing withdrawals dramatically improves the situation. But this may not always be possible, so what do? Well, if we must tap into savings, be strategic. For example, if you have taxable accounts, start with interest and dividends from those taxable accounts, leaving the original investment untouched as long as possible. This can potentially capture more of the upside when the market does rebound. Similarly, tap into principal from savings bonds, CDs, other cash sources to potentially buffer this period of time. But if you do have to tap into retirement savings, consider selling lower volatility investments. These types of investments can provide liquidity, that is money when you need it, at relatively stable prices. So our takeaway: it's impossible to say with certainty what the future holds, but anything that you can do to lighten your reliance on large withdrawals from retirement savings during a market downturn can help to preserve your savings over the long term. Even small reductions to withdrawals can go a long way toward giving your portfolio time to recover and helping your savings last.